Hello everyone. So welcome to the 26th Sky High Symposium, and I'm happy to share with all of you that we have completed silver jubilee of our Sky High Symposium, and wishing you a very happy Diwali in advance and prosperous New Year. Today we have with us speaker CA Prerna Pishori and CA Richa Lumia, and this is the platform to motivate and encourage our women fraternity. It's my endeavor to serve the best to the members and specifically the women fraternity of our institute. And we have with us Deepa, Smita, Prachi, Akriti. I welcome all of you, the speakers and the coordinators, moderators, and all beautiful, intelligent participants, women chartered accountants. We have a council meeting going on, and lot of agendas we are clearing, such as new syllabus with Board of Studies. I have with us, along with me right now, Board of Studies Chairman, C. Danyavas Sharma, and Vice Chairman, C. Vishal Doshi also here. And I would like that they will also say hi to all of you.
Hello everybody, pleasure to be connected with you all. One way, okay. So it's pleasure to be connected with you all today. Always it is pleasure to be around the ladies, or as you say. And most important part is now we are actually doing the CRET, which has been approved by the council. And this is going to be the historical CRET, which we all are going to listen to at an appropriate time. We'll surely come and discuss with you about the syllabus, the way it has been designed. And this is going to be on a complete international level. So I'll surely make a point to might become and address all you ladies one day. Thank you. Let me give this phone to Vice Chairman Vishal Doshi.
Yes, sir.
Hello, very good evening to all of you. It's indeed a privilege to connect with all of you, and my compliments to all of you, Prithiven and the whole team, for completing 25 episodes of this particular event. I understand you are into the 26th event episode today. So my best wishes to all of you, and like Prithiven and Dev, I mentioned, there are a lot of things that are happening at the council, especially on the Board of Studies front, and we will definitely come around and interact with all of you as once we move ahead with those aspects. So my best wishes to all of you, wishing all of you a very, very happy Diwali in advance, a happy festive season, and a very, very happy learning. Thank you. Bye-bye. Handing it over to Prithiven again. Thank you.
Yes, sir. Hello. Hello. So it was privilege to have with us today Board of Studies Chairman Dayabai Chalbai, Vice Chairman with us, and it's my endeavor so that all of you can interact with all the council members. It's a really privilege. So my thanks from my bottom of my heart to Dayabai and Vishalbai for being with us and addressing to all entire fraternity, all the participants and friends. Again, we have the speakers with us. As I said, our council meeting is going on today. We have also signed MOU with SEBI and NISM, and we are having the first meeting of Institute of Social Auditors of India, and this is through Sustainability Reporting Standard Board of ICAI, and it's a great opportunity for all of you who are practicing in this CSR arena, and we'll have very shortly this session also. So stay in touch, block your date every Wednesday, 5 to 7. with WMEC office coordinator to take it further, and wishing you a very happy Diwali and prosperous New Year. Thank you very much. So we will be taking it, the first speaker of introduction of
Thank you, ma'am.
the speaker, first speaker, Prerna Pishori.
Yeah. Thank you so much,
Yeah,
ma'am.
Smita. Hi, Smita. Please take it first.
Yeah. Thank you so much, Preeti, ma'am. Hello and good evening to all. First of all, thank you everyone to taking a time to join with us for today's session. And it's been pleasure to me to introduce today's our learned speaker, CA Prerna Pishori ma'am. CA Prerna Pishori ma'am is a chartered accountant, LLB, LLM, DIIT and MCOM. She is a chartered accountant and international tax lawyer. She is a partner at Pishori Pachore and Jain. She has experience in international taxation advisory, transfer pricing, cross-border transaction advisory and structuring, D and startup advisory, litigations, etc. She completed her master's from WE Vienna as Foundation for International Tax Scholar 2019. She has been delivering lectures at various professional forums and has been teaching international tax law to chartered accountants and advanced diploma in tax, international tax UK students. She has been a guest lecturer in several national law universities. She has been also selected as a 35 future leaders in taxation by TaxScoop. She has authored many papers and books on direct and international taxation. This is very proud that she has been awarded International Research Award by ICAI. She is a convener of International Study Committee at CTC and IFA and BCS. Today, Prerna ma'am will throw light on today's topic on tedious obligations for NRI under Section 195 and 15 CACB. With this brief introduction, I request everyone to please welcome of our today's very learned speaker, CA Prerna Pishori ma'am ji. Ma'am, welcome and over to you. Thank you.
Thank you so much, Smita ma'am. Thank you so much, Preeti ma'am, for this opportunity. I'll just share my screen. The screen is visible?
Yes.
Yes, ma'am.
Okay. So this topic, I think, yeah. So this topic is very, very important, which is very current also and used in our day-to-day practice also, which is TDS on NRI payments. We face a lot of issues when we are making the remittance to the non-resident, or our clients especially are making the remittance to the non-resident, and therefore the question arises that whether we need to deduct the TDS, at what rate do we need to deduct as per the tax treaty, as per the domestic act, whether we need to file form 15 CA as well as 15 CB, where exactly to put it. So all these questions come in our routine day-to-day practice, and that's why we thought that this is a very, very important topic for the practitioners, and hence we chose this as a topic. So TDS on NRI payments, specifically, we have like section 195, which deals with the TDS obligations when the payment is being made to a non-resident. So 195 is a very comprehensive section. It doesn't cover few payments, which is like salaries, interest, which are chargeable under specific sections itself. So those are not covered here, but remaining all the amounts are covered over here. So if you see if salary payment is being made to NRI or non-resident, then the specifically tax has to be deducted under section 192. And then there are, as I said, certain interest payments which are specifically dealt with the other section. So other than that, 195 provides the coverage in terms of whenever the deduction has to be made while making the payment to the non-resident. Now the question arises, when exactly we need to make the payment, when exactly we need to deduct the taxes while making the payment to the non-resident. I think somebody's mic is on. Okay. So 195 requires when to deduct the TDS. So if you see, 195 says that any person responsible for paying to a non-resident or a foreign company. So when any person, be it resident or be it non-resident, so when the payment is being made to non-resident or to a foreign company, non-resident individual or a foreign company, both are covered whenever the payment is being made. And any person, it can cover NR to NR payments also. It's not just that only the resident person, when it makes the payment, only those are covered. No, we have several decisions wherein it has been held that even where one non-resident is making payment to another non-resident and the income is deemed to accrue or arise in India, taxes has to be deducted under section 195. So there is clearly an explanation also to 195 which clearly provides that NR has to deduct the taxes even when it does not have any presence in India. So it includes any person. What about a resident but not ordinary resident? And that is also covered. So any person covers everybody inside the first limb of the 195, which says that any person responsible for paying to NR or a foreign company. Then what is covered, as I said, any interest other than the interest which are specifically dealt in the other sections, or any other sum chargeable to tax. So any other sum chargeable to tax is covered specifically under 195. Now, what do we mean by the term any other sum chargeable to tax? Let's take an example that I am making the payment for the purchases I have done from a non-resident. So I have purchased certain goods from non-resident. I have made the imports. Now I'm making the payment. Do I need to deduct the taxes under 195? So one may say that entire purchase amount is not sum chargeable to tax, because what you charge to tax is the profit and not the entire purchase amount, right? For a non-resident who is receiving the payment from you, he would be offering to income only the profits from that particular sale which he has made in India. He's not going to offer the entire sales income to India. So therefore, it is on the sum which is chargeable to tax, on the component which is chargeable to tax, and not on the entire amount. Let's take another example, which is routinely what we find, which is on the payment for the purchase of immobile property. You buy immobile property from a non-resident. Non-resident was the owner. Now the issue arises whether you need to deduct the taxes on the entire consideration which is paid for the purchase of immobile property, or do you need to pay only on the amount of capital gain. So if you see, we have to pay it on the amount of capital gain because it says any sum chargeable to tax. So the entire sale consideration is not chargeable to tax if you observe. Entire sale consideration is never chargeable. What a non-resident seller will charge or will offer to tax is the capital gain on that sale of immobile property, right? So therefore, it is on that net amount what you have to deduct the tax. There was this Supreme Court decision in the case of Transmission Corporation, wherein the Supreme Court had held that the sum or the expression, any other sum chargeable to tax, would not include the cases where any sum payable to NR is a trading receipt, which may or may not include pure income. So here what you have to charge to tax is the net amount and not the gross amount. And then there was this decision of GE Technology Center, wherein Supreme Court again clarified that a moment when you make the remittance, obligation to deduct tax does not arise. It only arises when such sum is chargeable to tax. So let's say for an example that I have made certain payment to a non-resident which is exempt. Let's say, for an example, interest on NRE accounts, which is exempt. So whether on that amount also we have to deduct the taxes under 195? The answer to that is no. So moment you make a remittance, it does not create an obligation on the person making the remittance to deduct tax. The remittance is liable for tax deduction when it is a sum chargeable under the Act. So you have to see whether, first of all, it's a sum which is chargeable to tax or not. Also, as I said, you have to deduct the taxes on the net amount and not on the gross amount. So where it is a composite payment, or where the payer is unable to decide the proportion of the income element in that payment, which is chargeable to tax, then the payer has an option to make an application to the assessing officer under section 195(2). So when the payer is unsure of the portion of payment which would be subject to withholding tax, then there is a provision under section 195(2) which allows you to make an application to the assessing officer for him to determine the sum chargeable to tax and on what amount it will be deductible. So that option is always available. If you are able to determine by yourself, you can do it. So application under 195(2) is not mandatory. When you are unsure as to on what amount I need to deduct the taxes, then in that case, you can make an application to the assessing officer. Most probably what we observe in the routine day-to-day practice is that people conservatively deduct the TDS on the entire sale proceeds. However, if you do it in consonance with the Supreme Court decision in GE Technologies, it's very clearly coming out that you need to deduct the taxes on the sum chargeable to tax and not on the entire sale consideration. If you are not able to determine, just approach the assessing officer. Right? Now, what is the timing of deduction? So, when you have to deduct, we understood who has to deduct, we understood what is covered. Now, third question which arises is the timing of deduction. So, on credit or payment, whichever is earlier. Right? So when you make the payment first or when you credit it in your accounts at the time of accrual of that expenditure, you need to deduct the taxes. There are, of course, the decisions in the context of the tax treaty, because tax treaty uses the term that when the income is paid, the treaty uses the term, especially in the context of royalty, FTS, interest payment. There, if you observe, para 1 of Article 10, 11, 12 of the tax treaty generally uses the term paid. So many of the tribunals and courts have interpreted the term paid appearing in the tax treaty to mean that only when the payment is happening, only then you need to deduct the taxes. But in my view, those decisions are very far-fetched because you cannot import the domestic law meaning of the term paid into the tax treaty. Tax treaty does not determine the timing of deduction. Timing of deduction is determined by the Income Tax Act, and the Act is very clear. It says credit or payment, whichever is earlier. Treaty never decides. Treaty's role is a very limited role wherein it decides how much each country has the right to tax. So there are several decisions on that context. So next question which arises is, at what rate you need to deduct the taxes? Now, if you see under 194J, 194C, you are given a rate which is a fixed rate of 10%, 2%, whatever. Under 195, it just says rates in force. Now, what do we mean by the term rates in force? Rates in force is defined under the Income Tax Act under section 237, which says rates referred to in under the Act, either Income Tax Act or the Finance Act, and the rates which are referred to in DTAA. You have to compare both of these rates, the rate under the Act. If it's a specific rate, say for example, on royalties, fees for technical services, you have the income tax rate available under 115A. And if that rate is more beneficial to the taxpayer, you will take that rate. If the DTAA rate is lower, you will take that rate. But always the first determination has to be made whether or not the amount is chargeable to tax. So say for example, the sum could be chargeable to tax under the under the Income Tax Act, but it may not satisfy the chargeability under the tax treaty. So say for example, you have fees for technical services. In many of the DTAAs, India, US, UK, Singapore, you have make available test. So only when you make available the knowledge to the recipient, service provider makes available the knowledge to the service recipient, only in that case, the FTS is said to be satisfied. FTS test is said to be satisfied in the source country. So let's say for an example, I have provided some testing services. Now in that particular case, I have just provided my knowledge. After this service ends, next time when you want to test your goods, you have to again take my service or anybody else's service. You cannot do it on your own. So therefore, the make available test is not satisfied, and in that case, FTS will not be taxable in India. So it depends on treaty to treaty. Now, if for the first place, the FTS is not taxable only under the income tax under the tax treaty, though it is taxable under the Income Tax Act. There is no question of determining the rate of TDS. Because when we are saying that the sum is not chargeable to tax only, then you don't move to the fourth question, right? Or let's say for an example, I'm taking up this particular lecture with you, and after this, you are able to apply your 195 knowledge. So I've made available. This is FTS. And therefore, whatever fees would be there paid to me would be chargeable to tax in India. On that, you need to then determine whether the rate under the Income Tax Act of 10% is beneficial or whether the rate under the treaty is beneficial. The next question which arises for the rate of TDS is that whether surcharge has to be added, whether cess has to be added on the TDS rate. So let's say for an example, you have 10% under 115A. So there, obviously, you will have to add the cess. So it becomes 10.4. Whether you have to add the cess or the surcharge on the treaty rates also. So the answer to that is clear no. So if you read the treaty language, it says that the tax shall not exceed whatever percentage is prescribed, which is 10%, 15%, whatever. So let's say, for example, under the Act, under 115A, the tax rate is 10.4. Under the treaty, the tax rate is 10. So then somebody may say that, okay, 10.4, 10.4, both in tax and treaty, Act and treaty, it's same. So whatever I choose is fine. But that's not the case. Under the treaty, it will only be 10 and not 10.4, or you will not add even surcharge to that. Treaty rates are not to be topped up with the cess or surcharge. So you will compare 10.4 under the Act or adding up the surcharge, and you will compare it with the 10% available in the tax treaty. Since 10% under the treaty is more beneficial, you will take that rate. Right? And there are again decisions to support that particular view also. There is a possibility, that under 195, when you are deducting the taxes, in that particular case, if you see, sometimes the invoice has the service tax or the GST amount also. So then in that particular case, whether you have to deduct the taxes on the entire consideration which is being paid, which includes your service tax as well as GST, or you have to deduct the taxes only on the component of the service and not the GST amount. So you cannot deduct the taxes on taxes. So GST has to be excluded. So even if it's a consideration which you are paying, But that consideration is not for the services what have been rendered to you. It is for the GST. It's for the taxes. So on that component, you are not required to deduct the taxes. Only on the component which is exclusive of GST, only on that component you are required to deduct the TDS. Are we clear? Then there is another possibility that sometimes the non-resident may not give you the PAN. Not sometimes, many times it happens. We are observing that non-resident are not willing to take the PAN in India. Then there is section 206AA, which says that the higher rate shall be deducted if the non-resident or if any particular payee is not providing or furnishing the PAN. Or even if, say, for example, incorrect PAN is furnished or invalid PAN is furnished, then also 206AA will be applicable. And what section 206AA says, 206AA is very, very clear. It says that rate under the act, rate under the or the rates in force, which means act or treaty, whichever is beneficial rate, or the 20% rate, whichever is higher, will be applicable for the purpose of your TDS obligation. So therefore, there is some kind of, this was very onerous provision for the non-resident to have the TDS at 20% rate. And therefore, there was some relaxation which was introduced by way of Rule 37 BC. So PAN is not required if the specified incomes are made to the non-resident. Which kinds of income? Interest, royalty, FTS, capital gains. Business profession income, you have to obtain PAN. On that, 206AA is applicable. It's only on the interest, royalty, FTS, and capital gain. Provided the NR furnishes the TRC and its tax identification number. What is tax residency certificate or TRC? TRC certifies, or TRC is issued by the authority of their home country, which certifies that this particular person was a tax resident for so and so year. And if the NR furnishes its tax residency certificate, its tax identification number, for example, we have tax identification number as PAN, Aadhaar. So if they furnish that, then they may not be required to obtain the PAN in India. Right? So if the TRC, PIN, or name, email address, all of that address is being furnished, then relaxation can be available from 206AA. Are we clear? There is also Form 10F, which is to be furnished as per the Section 90 of the Income Tax Act. So Section 90 says that if the details of the TRC are incomplete, so TRC is not a very standardized residency certificate. Each country has its own format for issuing the TRC. Right? So if the TRC sometimes does not provide the address, sometimes do not provide the name, name as in the email address and all of that. Sometimes the TRC does not provide the year for which year it is being issued. So there are different countries which have the different formats of TRC. Now, in that particular case, you need to then furnish Form 10F. Form 10F used to be a self-declaration form. It used to be a self-declaration form, but recently Form 10F is required to be filed online. So for filing it online, again, you need to obtain the PAN, because you have to go to your income tax e-filing website. There you need to select the Form 10F and then you need to obtain that. So if you see, there is a kind of dichotomy which is existing between 206AA not requiring the PAN And Form 10F, new e-filing requirement, requires you to have the PAN for obtaining the Form 10F. So in that case, what needs to be done? So see, you need to obtain the TRC or Form 10F when you are required to obtain the treaty benefit. When you are obtaining the treaty benefit, only then the TRC is required. TRC is not required if you are going as per the Act. So let's say, for an example, I have deducted the taxes as per 10.3% under the Act, or so 10.4% under the Act. Then in that case, TRC and 10F is not required. So TRC and 10F is required only when you are claiming the treaty benefit. Now, there is a view that if you are claiming the treaty benefit, you are required to file your income tax return. If you are required to file your income tax return today or tomorrow, you will have to obtain the PAN. So even if Form 10F is requiring to obtain PAN, it's not something which is incongruous with the requirement of Section 206AA. So 10F, for that, if you want to take it up, you have to take the PAN, right? And you have to attach TRC along with that. Now, what if the 10F is not furnished electronically? Then in that case, payer is not completely responsible. So payer can take a declaration if the payee is not giving you the Form 10F. You can take a declaration from them. And this is for the remittances which are from financial year 22-23, which is applicable, right? Also, in TRC, if you see, there are many issues which arises. Some of the TRC are not in English. Sometimes the TRC, as I said, have the calendar year and not the financial year what we follow. So it is issued from Jan to December. Sometimes when you're making the payments, especially in December or January, they will not give you TRC very quickly. They will take 1.5 months, but the payment has to be released at that point itself. So how do you deal with those kind of situations? So in that case, you need to take a declaration from your payee that they would furnish you TRC as and when it is given. Sometimes your client might say that we do not have the TRC for this particular year. We have applied it. Take the application form. They might give you for the last year. Take that as a basis and request them that as and when the TRC is issued, kindly provide that. However, there are decisions which have held that non-furnishing of TRC does not lead to the rejection of the treaty benefit, because TRC obtainment is a procedural exercise. It's not something which is substantive exercise. So even if the TRC is not given, it cannot act as a limitation to the treaty benefit. Are we clear? So therefore, in that particular case, try to, as much possible, obtain these documentation for your own safeguards, because you are issuing 15 CB. So when you are issuing 15 CB, you are putting your signature, and any kind of wrong certification also attracts penalty of as high as 10,000 per certificate. So therefore, it is very much suggested that you obtain these documentation as much as possible. Are we clear? Now, when it comes to, say, for example, 206AA, again for that, whether we need to add surcharge and education cess, answer is no. On 206AA rate, we don't need to add surcharge and cess. Are we clear? So there we have the decision that 206AA rate 20% is the final rate. You don't need to add any surcharge or cess to that respect. Also, when, say, for example, you have a treaty rate which is lower than your 20% rate. So will 206AA override the treaty rate? There are both kinds of view which exist. So one view is that the treaty provisions override both charging and machinery provision. 206AA is a machinery provision for the requirement of obtaining the PAN. And therefore, it will not override 206AA. The other view is DTAA rate does not apply to the TDS provisions, which are provisional in nature. DTAA rates are applied at the time of deciding the final tax liability. TDS is a provisional mechanism to obtain the taxes or collect the taxes from any person. And if the domestic law provides a higher TDS rate, then in that case, you have to comply with that particular obligation. So that's about 206AA and TRC and Form 10F. So as I was talking to you, that there are certain common issues which arises in the context of the payments which are being made. So TDS on purchase of goods, as I said, purchase for the export is not liable to TDS. You have an exclusion under section 911. And if you have the purchase for the purpose of sale in India, you have purchase operations, then in that case, it will be taxable. But on what rate you have to, or on what amount you have to deduct? Then on the income element and not on the entire consideration of purchase what you are paying. Export commission, as I was saying, that export commission, again, we have many decisions wherein it has been held that the export commission is not fees for technical service. It is for the purpose of business carried on outside India. So it depends on the facts and circumstances of the case whether export commission is taxable or not. So export commission is not always taxable or is not always exempt also. So there are cases wherein it has been held that the export commission is taxable because the facts of that case provide that particular create that particular kind of obligation, because the export commission is which is being paid is in the nature of some technical service or consultancy service. However, in cases where it is not any kind of technical service, there the agent is just receiving the payment for the purpose of sales, which he's doing, he's not applying some of his technical knowledge. So in that particular case, export commission will not be treated as fees for technical services. So it depends on the facts and circumstances of each and every case. So there's no generic answer available to that, right? Also, there were certain circulars around that. Circular number 23, which were in connection with the taxability of the portion of profits which are exempt under section 911B. There were these other circulars also which have been withdrawn. So withdraw. I'm so sorry. Yes. So withdrawal of the circulars does not directly lead to the fact that the export commission is taxable. So these were the old circulars which were given in the context of the export commission. So just because these circulars have been withdrawn does not lead to the fact that export commission is now being taxable. You have to, as I said, examine based on the facts and circumstances of each and every case. Then the royalties, which is again most observed payment, software royalties, the database subscriptions, website hosting, all of these charges. So we have a very recent decision in the context of engineering analysis by the Apex Code, wherein it was observed that where the right to use is not technically given, then it is not to be treated as royalties. Right? So in that context, you need to examine the other nature of the payments also. For example, digitalized transactions, database subscriptions, website hosting, whether drawing the analogy from that Supreme Court decision, they are taxable as royalties or not. You also need to go to the relevant Copyright Act to understand whether they have any implications in terms of the copyright, granting the copyright. See in those cases whether there will be any equalization levy or not. right? So we have on the e-commerce transaction, on the digital ads, we have the equalization levy also. So you need to take into consideration both the things, that whether the equalization levy will be applicable or whether it will be treated as royalty payment. Are we clear? Next is in relation to the fees for technical service. As I said, technical, managerial, consultancy services or professional services are included in FTS. You need to see under DTAA to DTAA that whether there is make available clause or not. If there is make available test, then you need to satisfy that test. Only when you make the satisfaction of that test, then only the taxability will arise in India. So if it's a general kind of language which is as same used under the act, then in that case there is no there will be TDS. But if it's a make available test, it's very narrower compared to the act. Transfer from NRI's own account. This is also very common thing which we observe is that NRO account if you transfer from NRO account to NRE account, then in that case, do you need to deduct the TDS? Answer is no. There is no element of income which is involved because you are shifting your funds from one pocket to another pocket. But you would observe that banks insist on Form 15CA and 15CB. Not only 15CA, 15CB also the banks insist. So you may say that there is no requirement under the Act to have Form 15CA-CB issued. But the banks do insist for that, and then you will have to give it. But be very cautious that you look at the income tax returns filed by NRI, you look at the source of the funds lying in the NRO account, whether they have been offered as income or not in the relevant year. And you need to check all these documentation. So let's say for an example, on gift which are made to relatives of NR, there also you have now chargeability to tax under section 918. So you need to look into all the aspects of the act as well as treaty to determine whether or not the income is chargeable to tax, whether it is accruing first of all in India, what the treaty is saying, then determine the tax rate. Also, the next question which comes is, what will be the exchange rate will you take? What is the exchange rate you will consider for the purpose of converting your income? So sometimes the payment is being made in the foreign currency. So then in that very case, you have Rule 115, which talks about the rate which has to be considered, and it has to be the rate on the dates the tax is required to be deducted at source. Also, for the income conversion, you have under Rule 115 specific rates which are given. Are we clear? Then, as I was talking about the application for lower or nil withholding taxes, if you are not clear about on what amount you have to deduct the taxes, then the payer can make an application under 195(2). It is not mandatory. You have to make an application to the AO, submitting all the relevant documents to determine the appropriate sum chargeable to tax. And if you're not satisfied with the order of AO, you can make a revision application under 264. If the payee himself wants to make the application, he has an option under 195(3) or under 197. Under 195(3), only the eligible payees are covered. Under 195(3), 197, all the payees are covered. Under 197, you have to make an application in Form 13 for determining the tax liability. On the income, you have to give the estimated income, you have to give the returned income of the past 3 years, whatever advance tax you have paid. And based on that, the AO will determine whether there is a need to have the income chargeable to tax in India, whether nil or lower withholding taxes should apply in this particular case. In case you are not satisfied with the order of again 195(3) or 197, you can make a revision application under 264. But you cannot appeal. 195(2) you can appeal. 195.3 and 197 you cannot appeal. Against 197 you can file a writ petition. Right? So that's about the 195.2, 3 and 7. Now coming to the remittance obligation. So when the remittance is being made, as I said, there are certain forms which are need to be filled, which is form 15CA, 15CB. Section 195.6 says that any person responsible for payment of any sum to NR, whether or not chargeable to tax. Now, if you see 195.1 says only the sum which is chargeable to tax. 195.6 obligates you to obtain 15CA or 15CB wherever applicable, whether or not sum is chargeable to tax. Rule 37BB, which is for 195.6, it says sum chargeable to tax. But the Act itself says whether or not sum chargeable to tax. So whether Act will prevail or the rule will prevail, Act will prevail, obviously. So even if, say for example, you do not have an obligation to deduct the taxes, but still you are required to furnish form 15CA, 15CB. 15CA is divided into 4 parts. Part A, where the remittance does not exceed 5 lakh. Part B, where you have taken the certificate under 195.2, 195.3 or 197. And part C, where you have taken 15CB and where the remittance is exceeding 5 lakh. And part D, where the sum is not chargeable to tax, other than the payments which are referred to in 37BB2. 37BB2 talks about certain kind of payments for which 15CA is not required to be furnished, which are 33 items which are listed in Schedule 3 of FEMA. Now, remittance can be to different country, different from the residence. So the bank account could be in Singapore, the person could be resident of, say, USA. That's all right. Right? And what are some practical issues again in 15CA-CB? 15CB is your CA certificate, right? But 15CA, in which particular part you need to file your remittance. So let's say, for example, income is taxable under the Income Tax Act, but exempt under the DTAA. Whether you need to report it in Part C or Part D. So if your income is taxable under the Income Tax Act, but exempt under the DTAA, you are ideally required to report in Part C because you are taking the exemption. It is not that it's sum not chargeable to tax. It is a sum which is not chargeable to tax, but you are claiming that exemption for which 15CB is required. So where the remittance is not at all chargeable to tax under the Act. Part D says under the Act. It is a sum which is chargeable to tax under the Act, but exempt under DTAA. So for that, you need to fill Part C and not Part D. So if the make available test is not satisfied, you need to fill Part C and not Part D. Correct? So you have to be very careful of which part, because then otherwise there will be the penalties or consequences for not furnishing 15CB. What about there is a loss? Say, for example, if the shares are being sold at a loss, there is no income which is chargeable to tax under the Act. It is a loss. Then you can go to Part D. Also, the other practical issue which arises is in terms of the credit card payments. Most of the time, our clients make these digital payments through directly credit card. And where the bank is not involved, are they required to obtain 15CA-CB? Answer is yes, they are required to. But most of the time, they don't inform us. So you have to tell your clients that you are required to obtain 15CA-CB even when you're making the payment through credit card, even when you're making the payment through PayPal or through Bitcoins these days. Because the Act does not give you any exemption for that. Right? Now, these are some of the practical scenarios. But as I said, you need to keep your documentation very robust. What are the consequences if you do not deduct the taxes properly? There could be disallowance of expenditure altogether under 40A1. The payer can also be treated as representative assessee under 163. It could be treated as assessee in default. The payer may not be treated as assessee in default if the NR has filed the return and offered that income and paid the taxes. So if the payer is treated as assessee in default, interest 1%, 1.5% will apply for taxes not withheld or not paid. There will be penalties also for failure to deduct taxes, for failure to file the TDS return. Also, for failure to furnish incorrect information, as I said, on a chartered accountant also there could be penalty of 10,000 for each of the certificate. And there could be again the prosecution also on the taxpayer. Are we clear? So therefore, what is the checklist that you have to keep when especially you're examining these non-resident payments? You have to go through the agreement, you have to go through the invoices, contracts, understand the transaction details. If you're not able to understand, go to their website and check. Ask for the email exchanges. Obtain Form TRC, Form 10F. Obtain the beneficial owner declaration that the person is the beneficial owner of the income. Obtain the no PE certificate that that particular person does not have any PE in India. Determine the nature of the income and characterize it properly under the Act as well as under the treaty. Look into the treaty to determine whether the treaty is first of all applicable or not. Also, go through the treaty in entirety because there are certain clauses. For example, there is most favored nation clause which allows you to import the lower tax rate from the beneficial treaties signed with the other countries. So it is possibility that you have made the interest payment, you have made the royalty payment, and there is a lower tax rate which is available under the other DTAA, and in your DTAA there is MFN clause which allows you to import that rate from other DTAA, or which allows you to import the make available clause. So though you don't have a make available clause in your own treaty, but it has MFN by virtue of which you can import the make available from the other beneficial treaty. So you need to read the protocol to the treaty. In the protocol to the treaty, you may find certain limitation of benefit clause, whether that is applicable or not, because those are tax avoidance, anti-tax avoidance mechanism. So all of that you need to check in detail to safeguard yourself from any kind of wrong reporting. Also, if we are witnessing that now we have the multilateral instrument, we have BEPS, we have transfer pricing, we have GAR. So there are so many other anti-avoidance mechanisms which are already in place. So whenever you are issuing Form 15CB, please be very cautious because wrong reporting can have the implications on you. So that's all from my side. Thank you so much.
One question, ma'am.
Sure.
You have mentioned one important aspect of credit card payment or payment to Bitcoin requires 15 CACB. So when we come to know about this, the client has already done these transactions. So how to comply with this?
So that's a problem which arises. So you have to, as I said, tell your clients that please inform us in advance when you are undertaking these transactions. So once it is undertaken, you cannot do it like for a backdated period as long as like 6 months back. You can do it for like 1-2 days or maybe 15 days prior, but you cannot issue a backdated 15 CACB like a year prior when you especially come to that audit stage of your client. So therefore, you need to tell in advance to your client that whenever you are doing these kind of payments, please keep us in loop so that these kind of certifications are obtained. But I must tell you, my experience suggests that the clients are very rigid because they feel that they have to pay for 15 CACB charges also, and why to pay because nobody is asking. So you have to tell them the repercussions also that if you do not file it, if you do not obtain it, these are going to be the consequences for that.
Thank you, ma'am. I request Deepa ma'am to give a vote of thanks. CA Deepa Goswami. Okay, maybe some technical issue, I think. Thank you, Prerna ma'am, for handling such a nice topic and explained it in a nice way. Many aspects are covered with 15 CACP and any implications of 195 and new aspects for our understanding. Thank you very much.
Thank you so much.
Yeah, I request next coordinator Akriti Kohli to introduce our second speaker, CA Richa Lunia.
A very warm welcome to all my fellow colleagues. I am CA Akriti, and it gives me immense pleasure to introduce our next speaker, CA Richa K. Lunia. Richa is a practicing CA and she's a partner at Messrs. RS and Associates. She qualified CA at a very young age of 20 with 37th rank in IPCC. Also, at the age of 21, she became the youngest elected managing committee member. Since then, she has held various positions as Vice Chairman of Bikaner Branch, Secretary, and Sikasa Chairperson. In fact, the first ever Sikasa committee in Bikaner was formed under her leadership. Also, it makes me very proud to tell you that she is the first female managing committee member of the Bikaner branch. She has qualified DISA. She has a certificate course in forensic audit, concurrent audit, and arbitration, meditation, and conciliation. CA Richa is a regular speaker at the national and international conferences which are being conducted by ICI. She has moderated various webinars of ICI, Board of Studies, and Women Members Empowerment Directorate. She has also presented various papers at various conferences. Her paper on impact of foreign currency devaluation on Indian economy was awarded as the best paper at National Convention of CA students in Ahmedabad 2015. In fact, she has also got the best presentation tag at the 4-week residential course at Excellence Center, Hyderabad in 2017. She also participated in JET's Jen Youth Exchange Program in USA in 2016 as conducted by JITO. I warmly welcome CA Richa ji here, and today she is among us to speak on the topic of importance of CAs in a startup. Welcome, Richa.
Thank you so much, the moderator for my session, Sia Akriti Kohli ji, for the warm welcome. I'd like to thank the Women Members Empowerment Committee led by Sri Priya ma'am and Preeti ma'am for organizing such wonderful, webinars every Wednesday for the fraternity at large, empowering the women members. So thank you so much for giving me this opportunity, and it is indeed a pleasure to be amongst all of you and sharing my views on a very burning topic, a very fascinating topic, that is the startups and what is our importance as chartered accountants in this startup ecosystem or the startup world. So I would like to share my screen now, and then we can start the discussion forward. Can you please confirm if the screen is visible? Okay, thank you. So, dear members and participants, you all must have heard a lot about the startup because this is such a buzzword these days, especially after the this show of Shark Tank. People have got to know about startups so much, although the reality is that this was existing, the startup policy in India was existing way long back since 2016. So this is a very interesting topic, and more interesting is to know about our role and how we can be real contributors in nation building. So let's begin. This is a short disclaimer. So basically, today I won't be going into the basic nuances of LLP versus private limited company, or the basic registrations of PAN, TAN, the MCA company registrations, and getting the GST registrations, getting the DIN number, etc., the labor laws. However, we'll be dealing with the practical aspects on how we can grab this opportunity and how we can help in this startup story and startup ecosystem, because these are obviously, because of paucity of time, it is not possible to discuss the basic things which you all are very well aware of also. So I believe sharing the practical nuances and sharing what is there in the ground reality along with few of my experiences would surely be helpful for all of us, because these are the areas where we as chartered accountants have lot of opportunities, and uh, there are various ways, various roles we can play as chartered accountants. So before going into that role, let us first understand what the startup ecosystem is all about, and what exactly it revolves around. So basically, startup begins with education. How? Let me tell you. Institutes like IIT, IIM, Triple IIT, etc. They all have their, startup cell in the colleges itself, in the university itself, where they're promoting the students to, think of new ideas and then implement it. They have their own incubation centers, and then there are mentors, incubators, accelerators. There are funding organizations, there are support organizations, then there are angel investors. You might have heard all these terminologies somewhere or the other. These all are the part of the startup ecosystem, who in their own ways contribute to the growing and nurturing of a startup. Now, CA is one profession and diversified roles. We are a total business solution provider. How we, when we say the word CA, the most basic thing that comes into our mind is auditing, that we can be auditors of the startups. Well, it is much beyond that. Not just our role as auditors, but we can play many various roles, helping them to be their business solution provider. So whenever a client comes to us and he says that I have a new business, do you classify it as a startup? How do you determine that this is not just a normal, ordinary business, but this is a startup? So there are a few checklists, which is obviously the exact definition, which is given by the DPIIT, that these are the criteria to be met so as to qualify a business as a startup. Because this word startup has become a fashion nowadays. So everyone who's starting a new business, he says, I am starting a startup. That's not, actually not true, because they cannot be recognized until and unless they meet a few criteria, right? So the first criteria is, as you can see on the screen, that it should not be in existence for more than 10 years from the date of incorporation. Then second thing is, it should be either a private limited company or a LLP or a registered partnership firm. So generally partnership firms are not required to be registered, but then to be qualified as an eligible startup, you need to get it registered. Then third criteria is that the annual turnover for all the last 10 years, like since incorporation, obviously it cannot be more than 10 years, it should not exceed 100 crores. And one more thing is that this entity should be original one, new one. It should not have been formed by splitting an old or an already existing business, right? And then comes the last one, that is, it should be innovative and scalable, which is the most important thing. So basically, the first four things can be seen just by looking at their financials and the documents. All the documentation can show whether it's the company's age is less than 10 years or not, or whether whether the turnover exceeds or is within the threshold limit or not. But the last and the most important thing is that it should have an innovation. It should have an innovation in itself. That is, it should work towards development or improvement of a product, process, or they should have a scalable business model. So basically, either you should have an innovative business idea, or you should do something to improve the process. That is, you might be doing some existing thing only, but in a different way, which increases the reliability of the thing, or which increases the efficiency or effectiveness of the thing. So either there's a change in process, improvement in process, improvisations, or it is a scalable business model which has a high potential of this employment generation and wealth creation. So only and only if all of these criteria are met, then only we can classify a company as a startup. Okay, so now I'll be talking about the various roles which we as chartered accountants can play in helping these startups to grow. Okay, so first thing is our compliance role. Obviously, as I told you that after we see the checklist is done, if our client qualifies to be a startup, like it completes all this checklist, then we move ahead to the next step of getting its registrations. Registrations will be with the obviously income tax by getting their PAN, TAN, etc. With the MCA, obviously you need to do the basic decision of LLP versus private limited company, and that depends on client to client basis. And who better than CAs can guide what is best for our client with regards to taxation and other benefits, obviously as per the needs. But then generally startups prefer private limited company mode, because in the later stages of funding and angel investors, and when they want to get more funds, private limited company is a better and easier option. But then it all depends on client to client basis. And then after we get them registered with the ROC, we need to get them registered with the DPIIT, because that's the government authority to recognize startup, and that's the only platform through which we get various benefits of getting recognized as a startup. And then the regular compliances role, our services could be of filing the regular returns of the indirect tax, direct tax laws, and the labor laws. And then obviously doing the tax audits, applying for the exemption certificates. We'll be discussing more in the further slides. And then applying for IPRs also can be one of the compliance roles. However, do you know one thing, that generally the startups are owned by engineers? And what do engineers do? Like, not specifically engineers, but any person these days, whatever query they'll have, they'll first Google it, right? So everyone goes to Google and not to CAs, right? Because, and then they go to Google and they get these registrations done, because when you type on Google how to form a startup, or how to form a company, you will get 4 or 5 websites who will say that pay us 5,000, 10,000, and we'll get the company done for you. Okay, private limited company done for you. They get it done that way. And then the major problem comes when the compliances are not done properly, because formation is done by those websites, but then there's nobody to guide them on how to proceed further, what all forms you have to file, what all returns you need to furnish. And then they get notices for penalties and all that, and then they come running to us chartered accountants to solve their problems, which is one of the major issues which I see generally in the present era, because everyone resorts to Google for help. And well, I don't know if this is this is a kind of disadvantage only for us chartered accountants, because we cannot advertise our services that way. so we cannot directly reach out to them, but then there is a way, there is a solution, and our ICI only has provided it. Just wait and watch, you'll get to know by the end of the session. Or if you can guess, I'd love to hear your answers if you are available, if you're aware about this solution. So next comes the benefits, as I was talking about in the previous slide, of compliance's role which we can play, about the registrations with the DPIIT. So there are many benefits attached to it. When a startup gets registered with this DPIIT, then what all benefits it is eligible for is basically summed up on this screen. That is the self-certification under labor laws and environmental laws. So basically, the ESI, PF, etc., all these labor laws, self-certification would be enough for them. There would be no inspection from the department. Nobody will come to their, factory or offices, etc. So there'll be no harassment, and basically this is one way of ease of doing business. And then there are some relaxations in the public procurement norms. That is the GEM portal of the government. They have some relaxations of prior experience benefit, because the new startups, they don't have any experience, they do not have any turnover. So there are relaxations in the turnover criteria, experience criteria, etc. And then there are rebates on patents and trademark filing fees and support from facilitators. I think the patent fees is reduced by almost 50 to 80% for the startups, because see, patents is directly linked to innovation, and innovation is the bread and butter of startups, because every startup is wholly based on innovation. So it is very important for the government to give or to facilitate the startups in this way, so that their processes, their innovation are secured by patents, so that nobody else can, exercise any wrong copy. They cannot copy it wrongly that way. So there are many rebates given by the government in the legal fees, in the government fees. And then there are some income tax exemptions also, given to startups. Every one of you must have heard about the, tax holiday given to startups, that 3 of 10 years they can absolutely pay zero tax. And then I'll tell you in the next slide about the reality of it. And then, as easy and rosy it might feel, but the harsh reality is that there are many startups who fail, and hence they need to close the business, they need to shut down. So there is a provision for that also, in as a faster exit under the bankruptcy code. And as CAs, we have professional opportunities in that area also, because when a business starts till its growth, saturation, and completion finish stage, our role is imperative everywhere. To get the business closed also, we will have to play our role. So our professional opportunities will never cease to exist. Right now, as I told you, that we'll discuss more about the income tax exemptions, because that's something which fascinates the most to all us chartered accountants. Anything related to income tax, and we're all ears. So let's burst some myths and know the reality, because there's been a lot of hue and cry about the tax holidays given to startups, and then capital gain exemptions, ESOP exemptions, angel tax exemptions. What is the ground reality? There's a section 80 IAC, which is there for startups, which is introduced for startups, that eligible startups, obviously all these income tax, you all are very well aware that they all come with so many terms and conditions. This will be allowed only when so and so things are followed, and there's a list of conditions to be followed to be eligible, to get these tax benefits. So basically 80 IAC says that if you're an eligible startup who follows so and so conditions, you can choose 3 years out of the 10 years, and you can pay no tax. So 3 years should be consecutive years. So you can take the 5th, 6th, or 7th year where you pay zero tax. Like all your profit and gains would be exempt. You can claim the 100% deduction, or you can choose the 8th, ninth, and 10th year. That's absolutely your wish. But then the ground reality is, does everyone get this benefit? Do all the DPIIT recognized startup get benefit? No. The answer is absolutely no. Because for Section 80 IAC, a separate application has to be filed with the board, interministerial board. And when you get that approval, only then you can take this tax holiday benefit. And same applies to the angel tax exemption also. Section 5627B, when it was introduced to, because the motive of that section when it was introduced, that when a company issues the shares at premium, then taxing it in the hands of the individual as a gift because of the benefit he's getting. That was introduced to curb the unaccounted money of people trying to convert their black into white using the mode of the share transfer. But then that was the only time when the startup ecosystem just started nurturing or growing in our country, and that negatively impacted our startup ecosystem also, because startups are generally based on that funda that they'll find people who will invest in their company, and those investors will definitely get benefit when the uh, mm, price fair market value of that company increases. That's the only benefit the investors get, right? So if you put a tax on them, then how will they grow? How will the startup survive? So then came this angel tax exemption, in which you need to apply for it. You need to apply again a separate application, and then when you get the approval, then there's no taxation on it. The reality or the facts, if we see, is that 80,937 startups are recognized till date in DPIIT. And this data is as on today, morning today. If right now, if you check the Startup India website, it might have changed by a few numbers. Some 4, 5, 10 startups must have registered more. But basically till today, 80,000, more than 80,000 were registered, and the tax exemption for startups, if you can see, is just 596, which is less than 1% of the DPIIT recognized startups. So this tax exemption means those who are eligible for 80 IAC benefit, that is the tax holiday benefit. So only 596 have been, covered under this tax holiday benefit, as compared to the 80,937 which are registered and recognized by the DPIIT. So this is such a contrary and funny position, where one of the government departments recognizes it as a startup, and the same government's other body says, no, you're not eligible for the exemption under the income tax. So this is something which obviously needs to be taken care by the government. And yes, obviously our opportunity lies under all these recognitions. It is us who have to do these compliances, do the filings properly and all that. So next would be, after the basic compliance role, our role can be as a legal advisor, because startups have a lot of documentation and draftings which need our role as legal advisors as well. There are co-founders agreement to be drafted, then how to split equity amongst the co-founders, how to make sure that the co-founders are rights of them are vested properly, and then drafting the shareholders agreement, and privacy policies and IPR issues are all our legal roles. And then angel investments term sheet, the letter of intent, getting them all right, because angel investors are basically those individuals, those high HNI individuals who are willing to invest in the startup. So the documentations should be proper on both the sides. So if you are representing the startup, you need to make sure that the company, that is the startup's interests, are taken care of. And if you are from the angel investors, if you are a CA of an angel investor, then you have this role that you need to make sure that the documentations are proper and the startup in which your client is investing is not a fraud, and they won't run away with your client's money, and the money is going in good hands. And even if the business fails, what are the best possible options of safeguarding your client's money? So that's very important. And see, our clients trust us, they trust our decisions, so we need to make sure to put our professional judgment properly. And then that's what we discussed in the last point, that is the legal compliances for the investors as well as the company, both. Then comes our role as a consultant. As a consultant, we can help them prepare their pitch deck. We can help them in funding. We can help them connect to the correct set of people, the correct VCs, the correct PE players, the correct angel investors, and as well as a very important role comes in helping them get the government scheme benefits. There are various central government as well as respective state governments have their own startup policy, which they have given certain benefits. They have funds accumulated to be given to startups, and it is our role as a consultant to help them get these done, loan syndications and all. There's a recent scheme by the government, the central government, Startup India Seed Fund scheme, in which this Department for Promotion of Industry and Internal Trade, they have initiated this scheme with an outlay of 945 crore fund, which is to be given as financial assistance to those startups who give their proof of concept, their prototype, their trials and all. So they'll give some, those who give their prototype, or those startups who submit their proof of concept, they are eligible to get 20 lakh as grant, etc. There are various detailed scheme document, where we need to make sure that if our client is eligible for it, they get the benefit from the government. And so in this way, in the Startup India Seed Fund scheme, they've sanctioned 338 crores to 92 incubators. And incubators are basically the middle mediating authority between the government and the startups. So we need to reach out to the incubators, and then we need to we need to prepare the pitch deck. We need to tell them that what problem, like basically a pitch deck is like when a startup goes for funding and all, they give their presentation, right? And they tell what is the problem they are addressing, what solution they have, what is their product, what is the viability of that product. And then there are different stages at which startup goes in, right? There's an ideation stage in which the idea gets developed, and then further and further they come. There's a stage of MVP where there's a minimum viable product, or the traction phase where they start growing actually. So it is very important for us as consultants to guide them at each stage and get them the most of each stage, so that they can get all the benefits of the government schemes as well. And then next comes our role as a mentor to the startups. So basically these startups are generally done by the young generation. They get an idea, they see some problem, and then they think of it, and then they have idea, they have the technical knowledge, but then what they might lack is the expertise, the experience, the technical feasibility, the financial feasibility, and all that. So a very important role is played by the mentor in training them, in helping them, in advising them, in giving them the right direction, whether what they have thought, what idea they have, is it basically validating their idea, is it correct or not? Is it something which is workable or not? Can it be converted into a business model or not? So all this is a role which a mentor can play, in a startup's journey. So basically, if you think, or if you think about the Shark Tank episode, you will realize one of the sharks also was a chartered accountant. Yes, do you know that? Yes, C. Aman Gupta, you're right that he, the founder of both one of the startups, and he's a chartered accountant. He's now, playing a role of investor as well, and mentor, obviously mentoring the startups in which he has invested in. And then if we realize, or if we think about the various startups which have gained popularity among the few years, you can name anything and everything which we use in our general daily life, be it Zomato or Paytm or Ola cabs, or Swiggy, Airbnb, Cred. All of these companies, if we think that they have lesser tangible assets as compared to so many companies of their sector. For example, if we see Zomato, do they own any restaurants? No, they do not have any fixed tangible assets at all. But their net worth can be bigger than the biggest of the restaurant chains. So I remember one of the saying of Steve Jobs. He said that the smallest company in the world can look as large as the largest company on the web, and that's true that it is very well possible if Airbnb doesn't own any hotels, but its valuation could be more than the biggest, largest hotel chains in the world. You never know. So that's the reality of startups and the world we are right now in. And if you have any new idea, you can reach out to your mentor to understand whether that idea can be converted into a startup and a workable business model or not. And then comes a very trending role these days of virtual CFO. A CA can be a virtual CFO to startups. So basically, CFO means Chief Financial Officer. And startups being at the initial stage, they do not, have a proper CFO, in-house CFO, what we call it as in their companies, because of maybe lack of awareness, you can say, or maybe lack of money in the initial stages. And that's where our role as virtual CFO comes into picture, which is very important, because there must be someone. See, the people who start these startups businesses, they are all in their respective fields very expert, but generally they are not aware about the legal and the taxation part of nuances, and that's where they lack. And it can be so dangerous about these notices and all. If non-complied, they can lead to shutdown of the business as well, is because there are provisions which attract penalties amounting to crores if non-complied, and when they get notices, it can be very, very bad thing for them. So it is very important for them to have a person who has good financial knowledge, who can tell them what is good, what is not, what you should do, what you should not do. Because see, a startup person might be a tech guy or somebody who's not related to the commerce field at all. So he might not know what payments have to be done, on which TDS has to be deducted, or what all things should you take care of, what all payments are not allowed in cash and all that. So our role as a chartered accountant comes into picture to guide them, to tell them what should be done, what should not be done, because even unknowingly, what is wrong, what is not allowed by income tax is not allowed, and they can face huge penalties for the same. What like if if they're going for fundings, there are some norms to be complied with. Some forms have to be filed with MCA. If they are not aware of it and then they don't comply with it, then the penalties of MCA are heavy, very heavy. So as virtual CFOs, we need to take care of their financial, accounting, managerial, and business roles. Then the financial analysis, determining the key performance indicators, telling them about the using the Pareto rule, basically the 80-20 rule, that what is the place where they're getting most benefit but they're not putting efforts, and vice versa. Then giving them a dashboard to the management, telling them about their financials, giving them financial advisory, helping them in pricing decisions, cost control decisions, IT systems, determining, preparing the good internal control and system and processes, taking care of the branding, marketing. All these are roles as a virtual CFO, which a CA can provide to the startups, so that they do not miss out on any compliances. They do not inadvertently, because of lack of awareness and lack of knowledge, they do not get any penalties or notices, etc. So basically, these all are the roles which we as chartered accountants can play. And one more thing which can come to our mind is that we CAs cannot just, as if we say importance and opportunities for CAs in startup, we can definitely start our own startup. We can be an entrepreneur, and it's not necessarily that we play a role of consultant or advisor only, but we can have our own startup. We can have our own idea and start our startup as well. There's there's a startup named Mera Office, which basically is by CAs only, because it helps in the office management of chartered accountants, and basically digitizing the CA office. So if you have any great idea, help which solves your practice problems, the basic issues which you face while practicing, you can be your own entrepreneur and start your own startup, and you will save on all these costs of getting registrations done, because you don't have to pay fees to yourself, right? So basically, we can be startup founders and entrepreneurs as well. And then comes one of our role as startup valuers, preparing the valuation report. Because when your client, who's a startup, will go in front of the investors and he will make an ask for an amount, giving a certain percentage of their equity, the investors will obviously question, how did you come at that valuation? So your valuation should be very well prepared, taking care of all the considerations, using the best of the softwares, and making sure to not miss out on any of the points, because the investors who are going to invest are highly intelligent person. Trust me, they're not dumb people who will put their money in your client startup as it is. They are very smart, they know the business very well, and you cannot just give a fake number to them. You need to be very strong. Your credentials, your evidences, your valuations should be very strong, and then only you go in front of them confidently, telling them about you need so and so amount for diluting whatever percentage of equity you wish to dilute. Because the angel investors or the VCs, they have done their background studies and homeworks very well. So you need to have good reports. Financial modeling is one thing which we need to do well, and we cannot absolutely cannot just have any downside in these things, and we need to do these very well. And these services indeed are very crucial for us, and help us in playing a very big role in the journey of startups. Obviously, as I discussed earlier, we can also help our startup clients prepare their pitch deck, help them prepare their presentations in front of the investors, because I've actually seen the pitches also, and how the investors put on question, and there are startups who have absolutely no answer to their questions on how did they come to the numbers. So it is very important. Also, it is very important to educate our clients about how important compliances are, because generally when a person starts a new business, he's thinking about the idea, he's thinking about the technology he's putting in, he's thinking about all those things, but the least concerned he is about the compliances and the income tax and all that. But it is our duty as chartered accountants to make them realize how important this part is. Obviously, because this also comes with its own cost, and those people who are starting their businesses, they don't want to incur cost initially so much, but then it is our duty to tell them, to teach them, to educate them, to make them aware that how important role the compliances play. And if they do not comply with these things, or they miss out intentionally or unintentionally, it's going to be very heavy penalties for them. So it is our duty as their chartered accountants to tell them about what is right and what is wrong and how they should do. Like, preparing books of accounts is mandatory for a private limited company, right? And initially, when a startup is in its very nascent stage, they must not be having many transactions in their bank account. They must be just busy with their solution, whatever they want to provide. So there must be not many transactions, but still accounting has to be done. Whatever transactions are done, they need to be accounted for. So books of accounts have to be maintained properly. Obviously, this is also one other role of bookkeeping which we can provide to them. And it is very important that we take care of all these things, because if it is an LLP or a partnership, then there are different norms. But then if it is a private limited company, then there are different norms also. If we talk about the angel tax exemption or the AT-IAC exemption, it is only to the private limited or LLPs only, not to the partnership firm. And then these are only for the startups which are registered after 1/4/2016, and the last date was earlier 31st March 22, but that has been extended to 31st March 23. So on the contrary, all those who have been registered since the last 10 years can get themselves registered as a startup, recognized as a startup by DPIIT, but the income tax exemption certificates can be got by only those who are registered after 1/4/2016. So that is very important to make sure to understand, to figure out what all exemptions, what all benefits our clients can get out of it. And then I was telling you about one of the things of the solution, which one of the problem was of us as practicing PAs, was that we cannot advertise. So let me show you the solution. Just give me a moment. I'll share my screen again. Yeah, so I hope you're all able to see my screen. So this is the solution which ICI has provided us. That is their own startup gateway. So ICI has their own website of startup.ici.org, where we can log in and register as a business consultant or a mentor. And then, or obviously, if we want to be an entrepreneur, we can nurture our idea and make it grow here by registering as a startup. And you can see that ICI is providing a connect, a bridge between the startups and our CA fraternity, helping the startups to connect with the concerned uh, CA or business consultant. So here we can connect with the startups who need help in getting themselves registered or getting any of the things done which we have discussed. So basically, see here we can register as a mentor. Here we can register as a startup who's seeking incubation facilities in ICI, or we can register as a business consultant to shape the future unicorns. We can register our startup and get the largest ecosystem of mentors and success stories of CA startups. There are tools and resources for startups. What are the startup schemes, the incubation facility, the startup certification course, and the ICI startup exchange, which is there. So basically, what I was telling you just now, that you can register as a mentor to provide mentorship services to the startup registered with the ICI Startup Gateway. And then members can also join as incubator to start their own startup. And then we can register, members of ICI can register to provide business consultancy services in their specialized area. And then we can also register as an investor. Obviously, a CA can be an investor in a startup. So VC firms, angel investors, and investment bankers join us to make self-reliant India by funding startup to next level. And existing startup, we can register it with ICI and get the benefit of the mentors and business consultants. So you can just click here and register your startup with ICI platform, and then you can get these benefits. So there's a separate committee of ICI of MSME and startup which does all this. So I, as a member of the institute, felt it my duty to make you all aware that this is also one of the opportunity which ICI is doing for us. And then ICI also has its certificate courses and all that. You can check it out. Let me again share my PPT. Yeah, so we were discussing the various roles played by us as chartered accountants, and then basically what all we've discussed about is the compliance role, the legal role, the mentorship and consultancy role, the virtual CFO role, and the valuation and financial modeling and this sector role which we can play. And let's make sure to get these registered numbers higher than what they are at present, because you can see 80 IAC registered startups are less than 1% of the total recognized startups by DPIIT. So that's all from my end. These are all a very basic gist of what all ideas or services we as CAs can provide to the startups, and how we can grab opportunity in this buzzing economy of the startups. So if you have any questions, I'd be happy to answer them. And thank you so much. These are my just a second. These are my contact details. You can reach out to me if you have any more doubts, or if you want to have any more discussions about it. Thank you so much. Once again, thanking the ICI and the Women Members Empowerment Committee for this opportunity. Thanks a lot. Ma'am, you're not audible. Hmm.
Can virtual CFO
Yeah, I've received the question in the chat box. Can virtual CFO be an opportunity for women? Yes, definitely yes. Well, there's no distinguished or differentiation between men and women CAs because we all are CAs. But then, yes, those who wish to they can do this virtual CFO service. This is a very booming field because there are so many startups out here. And if you want to be a virtual CFO and you don't hold COP, then a lot of code of ethics provisions don't apply, and you can reach out to them and become their virtual CFOs and help them, guide them in all the financial aspects of their business. So definitely a yes, yes.
Thank you. Can you hear me now?
Yes, yes. Now.
Yes. Thanks for answering the question. And thank you, Richa ma'am, for guiding us this new area of practice where we can be a mentor, we can be a investor, and also for compliance services. And your starting is very good because everyone knows how to form it with the Google. But whatever is the compliance and guiding them in further progress, that is the main role of the CA, and which is a main role and which is a good opportunity for women chartered accountants. And again, the last part of the presentation is very nice, that many of us may not be aware about the ICI portal, which is available for us for taking the information, registering ourselves as a mentor or as a consultant, or even for the startups. Thank you very much for such a nice presentation. If CA Prerna Pishori ma'am is there, one or two questions for her. Can we have it?
Yeah, sure.
Yeah. One question is regarding reimbursement of expenses by Indian company to the US parent entity for software purchased by parent entity. Whether TDS is applicable.
So yes, as I was talking about that, there is the Supreme Court decision in the case of engineering analysis, wherein it has been clearly held that on the end user license agreements, as well as in terms of just the software purchase, where technically no right to reproduce is given, and it's merely just that you can download and use it for your own purpose. In those cases, software would not be payment for the purchase of software would not be considered as royalty, and therefore no TDS.
Okay. And one more question. Can we issue K1 to US investors for investment in India registered venture fund?
But I didn't understand how is it in relation to like TDS obligation.
Yeah.
Yeah.
It's a question from the participant that issuing K1 to the US investor.
Yeah, because K1 is actually a federal tax document, which is basically to report all the income, dividends, and whatever the shareholders' share is. So it is used to report is basically income distribution. Like for example, we have it in the case of REIT and AIF. We get that distribution list that what or in how REIT's hand the income has been offered to tax. In the similar way, it will go and get tax in the hands of the unit holder. So this is more to do from, I think, the US perspective, but I don't see an the TDS implication. What exactly the question is
related to K1.
Yeah.
Yeah. Okay. Yeah. Question answer session is over. Thanks to both the speakers for nice presentation and guiding the women chartered accountants for the new area of opportunity and enriching the knowledge. Thank you. Thank you very much.
Thank you so much.
Thank you.
Thanks to the Women Empowerment Committee for organizing such a nice seminar for all the CA fraternity. Thank you. We can end the session. Yeah.
Thank you so much.
Thank you. Happy Diwali.
Happy Diwali to
all of
you.
you.